All right, we're going to stick with the theme of ball of confusion, right? Because lots of people who are not in the stock market, they do want to get in, but they do have a few issues. Trust, and trust. My next guest is a certified financial planner and the very symbol of trust. I want to bring in our Wealth Enhancement Group Senior Vice President, Nicole Webb. Nicole, look at you. You just look trustworthy.
I mean, thank you.
What do you say when someone does walk into your office and say, listen, I've been grappling with this. I do want to get involved, but I believe the market is rigged?
Yeah. You know, I think our firm stance right now is that it's an incredible opportunity if you've been sitting in safety, that you can actually buy into these dips. And so we had kind of one.
But what about just the institution or the investing in the market itself?
No, you know, that actually isn't the sentiment that we're hearing all too often. I think there's a lot of confusion and frustration about what's to come after the election. More often than not right now, from a planning perspective, we're talking a lot about tax reform and the impact to American people. And then on the heels of that, estate tax reform. And so when you look at government deficit and some of that, I think there's just more concern over how much of accumulated wealth is actually going to be going towards future taxation, and how one thinks then in the face of investing today to offset that from a stewardship perspective.
That's a great point. That's a great point. Now, more near term, earnings, the mother's milk of stock market rallies. This is over the last year, earnings estimates for 2024. Obviously, they've come down a lot, but more recently, they've been moving higher, still below the 245 where they were about a year ago. Are earnings going to be strong enough to keep this rally going?
Yes. You know, I think under the theme of confusion, what we know in the industry is that generally analysts are 3 to 5% too bullish on EPS projections for the year ahead. And so to actually look on a 12-month rolling basis and say that we're flat, to us is actually a really strong indication. When you pull the graph forward even further, what we're seeing is some incremental uptick to EPS expectations all the way through 2025. And so baked into the market, yeah, I think there's strength and resilience there.
Let's talk about then the hot areas, or what has been the hot areas. In fact, a lot of criticism about this rally is that it's only been a handful of names. Although some of these big tech names have struggled, these are some tech names that you still feel comfortable with.
Yeah, you know, I feel comfortable with all of these, but I think it's one of these interesting times to look at where you have ownership in big tech. And so when we think about Google and the future competition, I know you already had a guest on earlier speaking to this, you know, their business today exists on the heels of search, and there's more and more search competition coming. We've actually already seen that with Bing and Meta. Amazon is really interesting because historically speaking, their own stock is relative versus themselves. And so again, when you look at kind of that future growth expectation for something similarly priced, Amazon to Apple, that future growth expectation lies right now within Amazon, not necessarily Apple, who's been spending more time doing stock buybacks and actually really needs a huge purchasing window.
Although I will say that $110 billion thing blew me away.
Yes.
I do believe, though, like $700 billion in buybacks. I would have rather seen them invest in AI research. So you talk about being a conservator of you know, all this money. We've got the old folks have all the money right now, and it's going to be the biggest transfer of money. But before they transfer this money, they're having a lot of fun. These are some pretty good ideas. You're saying, hey, baby boomers are spending, they're going to keep spending, and certain areas keep benefiting.
You know, I think there's a couple of things to just be really cognizant of as an investor. Baby boomers hold most of the wealth. They are benefited by rates being higher. They are not using leverage. And back to something I mentioned earlier, they are concerned about taxation and estate taxes in the future. So they are both spending and they are forward gifting some of that money. So when we look at names like the cruise industry,
Royal Caribbean, Hilton, MGM,
travel, it's all back, and it's on the heels of people who are benefiting from higher.
So then before I let you go, and we've got only 30 seconds, but what are you concerned about? It sounds like it's pretty smooth sailing in your mind right now.
You know, I am concerned about the bifurcation of the consumer and when that comes to head. So, you know, we heard some of the signaling noise from the likes of McDonald's. You know, we heard it earlier from the Dollar Generals. What you're actually starting to see is fast fashion isn't just fast fashion anymore. You're seeing fast trends from just a consumerism perspective. And so I think there is a bit of, right now, the consumer is saying overall that they are concerned, but their behaviors haven't matched that. We know that from Visa, MasterCard data, but that could roll over very quickly and start to trend upwards.
I mean, this last consumer credit report came in substantially lower than expected, only $150 million in credit debt. I mean, that usually is in the billions. So maybe it's starting to happen already.
Exactly.
Nicole, thank you very
Charles.
much.